Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to have everybody here. The entire objective of this show is to try to help people have the most successful retirement that they possibly can. We believe that really no matter what age, whether you're 20 or 80, working towards your retirement or already in it, knowing more about retirement planning, tax planning, and how to manage your assets can help you achieve a better retirement. Simple as that. And so that's what this show is about. We're just trying to impart knowledge as far as that goes. The format is a question and answer. So you can ask questions two different ways. You can send it in an email, asktom@talkmoneywithtom.com. You can see that right there on the screen. Or you can put it into the chat and we'll look at that also. And so we've already gotten some questions this week, so you can send them at any time, but you can also send them during the show as far as that goes. Those questions will be coming into Eason, who's sitting here next to me, and he will be our moderator. He'll ask the questions, and then I'll try to answer them, and Eason will finish up with some pieces or ask some follow-up questions, and we try really hard to give you, kind of a full-fledged answer as much as we possibly can. And so it's a really fun environment as far as that goes. And of course, if you want to continue your education past just watching this show, you can subscribe to the channel and get notified when we put content on this channel. It's all geared around those same areas. You can also, set up an appointment with us. If you want to meet with us, you just go to our website and hit the book appointment. Or you can get on our email list by just sending your email address to us at that Ask Tom address. So that's the format. That's how it works. It's a really fun event for us. We do this every single Friday from 12:15 to 1. So look forward to, hearing your questions and such too. I do always like to start the show off with a summary of kind of what I saw happen in the stock market this week. And this was a really fantastic week, actually. Going back to, the end of last week, we actually had 7 days in a row where the S&P 500 went up. And that was really exciting, actually, because we had this big downturn that happened in September and October. And in those 7 up days, we managed to get back to an all-time high again on the S&P 500. We closed at that all-time high yesterday, and really fantastic, wiped out all the losses that we'd had in that previous time frame. That sort of I call it a melt up. It was just very powerful, lots of different participation from different types of stocks, and I think this is really great. So today, it's a little bit down. We'll see what happens. Maybe we won't get to the 8th day, but it's not over yet, so we'll see how that plays out. But I'll talk about some of the catalysts that I saw and then some of the headwinds that are coming at us here. So the catalysts really were pretty simple. Number one, the decision to negotiate the debt ceiling and come to some kind of resolution to put the debt ceiling out to early December. Market turned around pretty much immediately at that point. So the next thing is really, I think the market is factoring in a lot of the positive information that's coming out around the negotiation on these big bills. We have the infrastructure bill and we have this Build Back Better plan, both of which, if they got passed, would be stimulative to the market. But more importantly, they would most likely include a debt ceiling increase in those bills. And that would give a huge relief, I think, to the market to have that debt ceiling, pushed out to early December of next year instead of this year. And so I think there's some good news happening there. I think the market's responding positively to that. But the other big catalyst is earnings. So throughout the time frame of the third quarter here, before earnings have been announced, a lot of pessimism. The supply chain is going to bring earnings down with all the issues there. The shortage of labor is going to bring it down. The inflation, well, it didn't, at least in the third quarter so far. For the companies that have reported, they've been very good. It looks like we're on track to maybe have about a 30% increase in earnings on the S&P 500 in the third quarter, which is fantastic. And so those are the pieces that are driving it forward. Looking forward, the things that we want to think about in terms of headwinds are really just two main things. I mean, I talk about a lot of different subjects, but for me, I try to boil things down to the basics and watch how those are working. So number one is the debt ceiling is only pushed off currently to early December. So it's something to watch. It looks like they might push these bills through well before that, but who knows? If they get close to an early December timeframe again, what we did last time was we pulled some of the stock market portions that we have off the table, just because a debt ceiling is a default would be a really big deal. Hopefully we don't have to do that. So we'll see what happens. And the other headwinds has to do with the Federal Reserve and just, they're going to cut back on purchasing these bonds and potentially start to raise interest rates. As a matter of fact, today the market was up in the morning, and then the Federal Reserve Chairman Powell, made some comments at a conference about cutting back on the bond purchases, and the market came down. So you can see that's an important component of what the market's looking at. But I want to kind of bring something in a little bit more specifically, because I think this is super important. We talk about all these things and all these hurdles these companies have to jump through. We talk about the S&P 500, or at least I do quite often, as this big kind of amorphous blob of companies. But I think it's really important to understand what is in those indexes. And the way the S&P 500 works is what's called a market cap weighted index. So bigger companies have a bigger portion of the price movement of that index. I'm going to read you a list of the top 20 companies on the S&P 500, which makes up 37% of the price movement. So it's a big piece of it, of that S&P 500 index. And I want you to think about these companies and how well they've done in dealing with adversity and different things, and in the past, and how well they might do in the future as far as that goes. So these are by size on this list. So Apple, Microsoft, Amazon, Google, Facebook, Tesla, Nvidia, Berkshire Hathaway, JP Morgan Chase, Johnson & Johnson, United Health, Visa, Home Depot, Bank of America, Pfizer, Walt Disney, MasterCard, Adobe, and Netflix. Think about that list. Those are some unbelievable companies that have done really, really well. And here's my key point. Basically, we have these issues. Think about it. We have this supply chain issues. We have shortage of labor. We have the inflation that's being caused. We have the Federal Reserve that might do some different things. Are these companies going to be able to handle that situation? Yes, would be my answer. They have in the past. And even though we do have these problems, they find ways around them. And the reason that they're so large is because they're some of the best in the world at running their firms. And so there are some potential issues that could happen even to these great companies, a debt ceiling default, or when they raise rates too many times. So for example, the 2008 downturn, they raised rates 21 times before the markets came down. It came down pretty hard in that environment. And really, again, keep in mind as a real basic concept here that the first increase they're talking about on Fed funds rate is in the end of next year, the first one. So we're a long ways away from having a lot of them. So the basics are there. Hopefully we pass these two bills, increase the debt ceiling so we can get to next December. And then obviously, these companies will be able to deal with these different situations that the Fed is having. Now, I'm not saying that the market won't come down some, and that always happens. I'm just talking about the bigger downturns are a lot less likely in this environment. And the overall upward movement of the market is a lot more likely in this environment when interest rates are this low. So anyway, really good week. Very, very fun to watch, actually. Usually markets come down fast and go up slow. This is coming up really fast. It was really fun to watch that as far as that goes. So look forward to being able to talk to you about what's happening next week. All right, Ethan, let's dig into some of these questions. I know we got some this week, and hopefully we get some more during the show. Fire away.
Sure. So a bit on the current news. There's been a lot of changes to the Build Back Better plan with new taxes and dropping of other taxes. So could you kind of give a basic summary, and then also there's a lot of things that were removed from it, and how do you think that affects the market?
Yeah, okay. So this is something I've been trying to keep up with as much as possible in terms of, the size of that package, what they're going to cut out of that package, and then the taxation issues. I do think it's important to understand that you got to be really careful about making adjustments to your situation based on a bill that hasn't passed yet. And this is a great example because throughout the committees and what have you, the one consistency has been trying to raise taxes on corporations somewhere in the 25 to 28% range, currently at 21, raising taxes on high income capital gains from 20% to 25%. Basically, a couple with 450,000 or more would have to pay 25% instead of 20. And then the last one is just the overall top tax bracket, which is currently 37% on the Fed basis, would go to 39.6, which is where it was before. Well, apparently Kristen Semena has decided that that's not going to happen. She's not going to vote for any of those tax increases. And so they're now scrambling around looking for other ways to do taxation. So some of the things that they're talking about now are taxing unrealized capital gains on billionaires, which is interesting, taxing stock buybacks. So if a company like Apple buys back $100 million, they would pay some kind of tax on that buyback, and et cetera. So they're trying to find alternate ways to fund this bill, and so I think that's kind of fascinating. We'll see how that plays out. In the end, it's more important that they get it through, and most important to me is that they include a debt ceiling increase into that, and get this done before early December, so we don't end up with another cliffhanger as far as that goes. They're talking more like a 1.9 trillion, $2 trillion bill instead of 3.5 trillion, which was the original proposal. They're going to be cutting back on some of the clean energy pieces. For example, the utility companies were originally in that one first plan, we're going to get money towards converting to green energy, or penalties for not doing so. That seems to be falling apart at this point in time. You also have they were going to do free community college for 2 years after high school. That seems to be off the table, and they're essentially keeping a lot of pieces but just cutting them down like by a third to a half. And so, we'll have to see how this all plays out. Again, it's all speculation until they really get through, with that bill, and we'll have some more information. It is important to kind of understand what is happening, especially once it's done, because part of a successful retirement is to be able to manage taxation correctly and manage your assets correctly. And so, how do those bills impact your returns in the stock market? What should you do to kind of make sure you're getting what you can out of that? And more importantly, how do those bills affect your personal tax return, which could be an issue as far as that goes. So tax planning becomes an important component there. So once we do know more, we can talk about it more. But those are the changes that they're talking about right now. I actually think the reduction or elimination of corporate taxation, no matter what people think about it, is a stimulative situation to the market. So if the market feels like corporate taxes are going to stay at 21 and not go to 25 or 28, that is going to be something that the market would move upward on, just because that means more earnings, and earnings are ultimately the piece that drives the market forward. So, it'd be interesting to see how that plays out.
Yeah, and so until you feel like until there's actual starting to vote on this bill, it's really kind of just a jump of the gun to make any kind of changes or actions based on it.
Yeah, I've heard, I've run into a lot of kind of misinformation. Oh, I need to sell my stuff now because the capital gain is going to go to 25%. And so there's a couple of fallacies there. Number one is that's now off the table. So that might not happen. But number two, that only happens for people with over 400,000 on an individual basis, or $450,000 on a joint filing basis. And again, I don't have any retired clients, for example, that have that much income that they're putting on their tax return at this point in time, unless something special is happening, like they're selling their house or what have you. But yeah, so you have to be a little careful of reacting to the potential of a bill. It's good to think about. It's good to have some plans. It's good to be ready, so that if you do need to make some decisions, you can do so. But making adjustments prior to the bill, that could be a little bit hazardous, in my opinion.
So another question relating to taxes is what is tax loss harvesting and how does it work?
Tax loss harvesting, that's actually a process that we employ here at the end of the year. So it's a good question, actually. So it's something that's a little bit seasonal. The idea behind tax loss harvesting is, let's say that you have a portfolio and it's got 10 different pieces in it, and let's say it's not in an IRA or something like that. It's in a taxable account, an individual account or a trust account or something like that. Um, and so the thought process would be that you want to kind of gather your losses and take those losses by moving to something else. There's a whole bunch of rules about what you can move to and how you can avoid what's called a wash sale. So if you go to something almost identical, I'll give you an example. So if you have Vanguard's S&P 500, the VOO holding. That's one of our biggest pieces. Let's say you sold that at a loss, and then you bought SPY, which is State Street's S&P 500. That's not going to be allowed. You can't capture that gain because it's too similar. So it has to be dissimilar. And unfortunately, it's a gray area as to what is dissimilar. But nonetheless, um, what we generally do is as we're making portfolio changes, we will make sure here at the end of the year that we capture all the losses that we can, because most of the times we have a lot of gains throughout the year. We want to offset those. And even if we don't, we can hold on to those losses, write $3,000 worth off of the tax return, and then write the rest of it off of next year's gains if we have it. So we are constantly hunting through for any losses that we can find, especially in today's world where there isn't a transaction cost within these exchange traded funds that we're using at TD Ameritrade. But that's what tax loss harvesting is. It can really add up. You have something that's at a loss. You sell it, you go to something that isn't exactly the same, but kind of similar, still in the stock market, and the market comes back up. Now you've captured that loss and you get to use it as far as that goes. Rather have no losses, but things happen, especially when you have a diversified portfolio. There usually isn't enough money to make everything in a diversified portfolio go up all at once. There's something that's going to lag behind, and that's just kind of how it works. Yeah, but that's a good question.
Yeah, and it's great to have these tax losses when possible because you can move from maybe you have an asset that has a sizable gain, but it's kind of underperforming the market.
Yeah.
And those are really hard to move. And so having some tax losses to offset it allows you to do some more portfolio readjustments.
Oh, that's a great point. Because that's exactly right. So let's say we bought something. This happened to us a lot. So last year we bought a lot of things that did unbelievably well, had huge gains. And this year they're not doing very well, but we can't really sell them because we have such big gains. Even though they're down some, they're still at huge gains, and some of them are even at short-term gains. Maybe we haven't had them for a year yet. And so if we have something that's at a loss and we could sell that at a loss, and let's say that we gather $1,000 worth of loss or $10,000 worth of loss, whatever it is, I can now go over to that highly appreciated asset that maybe is just not doing as well and sell a little bit of it at least and take that as, wash each other out. That gain that I get on that underperforming, used to be high performing asset is now offset by the loss that I took in this other piece. And I'm just still moving the money around. I'm still staying in the stock market, for example, or the bond market with that portion. I have to be careful to not be exactly the same, but generally speaking, the whole market moves in tandem for the most part. So anyway, that's a really powerful strategy.
So this question came via a YouTube video. Are Treasury iBonds, the inflation protected Treasury bonds, a good bet for an inflation period?
Yeah, as Ethan said, this came in as a comment on a YouTube video that we posted on our channel dealing with how to deal with inflation. So the question is, should you use Treasury inflation protection securities? We call them TIPS, just for short, because inflation is expected to kind of continue upward. And what we're seeing, for example, in the 10-year Treasury, it was at 0.5% in August of 2020. And right now it's at 1.62 or something like that percent. So as the yield grows on a Treasury, for example, or any bond, the price will fall. And so the idea behind a Treasury inflation protection security is that as the yields go up, so does the payment coming out of that bond, which should insulate the price from moving down as much. So it's got an adjustable rate of return on the upside. And so, yes, this is a great time to do that. We have an overweight position. We use exchange traded funds. There are a lot of great ones out there that buy these tips and put them in little baskets, and you can buy them yourself. Instead, we don't buy the bonds directly. We use them through these exchange traded funds, but that has worked out really well. Actually, our bond portfolio is outperforming the market so far this year. A big piece of it is because of those tips. Having said that, you can't really tell where things are going to go. I mean, I know by March, everybody thought inflation was super hot and then it fell, it wasn't as hot. Now it's coming back. And I mean, inflation has been out there as a thought process forever and hasn't always worked out that we actually have that much. We'll have to see how this goes. But nonetheless, you still want to keep your broad market bond market exposure. So we still have Vanguard Total Bond Market, for example, B and D in our portfolio. I still have some intermediate term treasuries in the portfolio, and I have short term bonds in the portfolio. I still have high yield bonds in the portfolio. So we are overweight our normal allocation by quite a bit, these tips, but don't get too carried away because again, they won't perform as well as some of these other things. So you always want to have this kind of balance amongst both your stock and your bond portfolios. And you really just want to maybe overweight based on some thought process or actual things that you see happening and react to those. And so, yeah, that I think that the tips are a great bet right now, that they've been working out well so far.
Yeah, and like another example of like an inflationary protected treasury bond is the actual iBonds.
Yeah,
But the only issue with iBonds is you're very limited in how many you can purchase per year. So I
yeah,
believe it's 10,000 if you
yeah,
buy you, and you have to go directly to the treasury and buy
yeah,
these.
yeah, exactly. So that, for us managing hundreds of millions of dollars, that's too limited for what we can deal with. I would say one other quick point is that another thing that you want to think about in an environment where the bond prices are falling is being in shorter term bonds, at least for a while here, because they don't fall as much. And so even shorter term tips, which is one of our biggest holdings, are not a bad idea, in my opinion.
So this is a planning question. Do you have any examples of like poor financial decisions made by clients that kind of have, changed how their or changed their plan in a sense or their success rate?
Yeah, this question came in, so I've been thinking about it. It's kind of interesting. We have 270 households that we are helping, and it's amazing actually how infrequently they do something wrong. Partly because they ask us for our opinion, but even when they don't, they still tend to do pretty well. And that's why they're our clients. That's why they have money. Because really, the people that aren't our clients, the number one financial piece that people mess up on throughout their lifetime is the inability to save. Almost all my clients have a very similar story, is that, my dad or whatever told me to make sure I save 10% or more, and then just pretend like it's not there. And so those people that can't do that, right, they aren't our clients. Because the average person here in the U.S. does not have a lot of money, and so sometimes there's no way to save because you don't have enough revenue, and enough income and those types of things. But that's a big one. But that's not within our clients. When I look within our clientele and look at some of the things that have happened, I would say one of the things is just a lot of people have almost all of their assets in their house and an IRA. Maybe that used to be a 401k at work. And nothing particularly wrong with that. That works quite well, but it does kind of create a little bit of a restriction. And so then they want to do something big with the money, and it's really hard to get big money out of an IRA because it pushes you up in the tax brackets, and you can end up spending an awful lot of money on tax as far as that goes. So I would say continuing to develop money outside, not just emergency account money, that's important, but money in stocks and bonds or what have you, that's in a taxable account that's outside of IRA is important. Um, so sometimes, that's something I've seen that could be improved. Then the sequence of withdrawals. So somebody gets into retirement. Where do you withdraw the money from? When do you take Social Security? Okay, that's a big issue. But even ignoring Social Security for a minute, where do you take the money from to live off of? And so I see a lot of people who just automatically go to start taking money out of their IRA accounts. And the comment I hear all the time is, hey, these are my retirement accounts, and now I'm retired, so I'm going to start taking money out of those accounts. But if you run the numbers, that's not as good as taking money out of your taxable accounts first because the capital gains are lower taxed. Some of that you've already paid taxes on, so you can get some of that money back without any tax, and allows the IRAs to continue to grow tax deferred, which can be quite powerful. You definitely don't want to be taking money out of your Roth type of accounts until the very end, because those are going tax free. So the sequence of withdrawal is another area where there seems to be a lot of confusion, as far as when to take what. So that's something I think that, is another area to focus on as far as that goes too. But for the most part, it's kind of amazing how well yeah, people have, made their decisions and kind of moved through their financial life. And again, that's why they're our clients.
Yeah, another one that we've talked about a couple times is letting your winners run. And sometimes we've seen where you sold winners too early, or these are kind of small pieces or assets of someone's portfolio, and it's maybe doubled, but they kind of said, "Okay, I'm selling now," instead of letting it run for a little bit longer.
Yeah, now that's a good point because you could be onto something. I mean, if it's already doubled in a fairly short period of time, whatever it is, or even gone up 20%, whatever it is, you could be onto something that could be huge. And we've got a client that bought $14,000 worth of Apple in '96, when it was not looking good for the Apple, honestly, at that time. And it's worth millions now, but that client never sold any. They could have. Maybe when it turned into 28,000, I doubled my money. To take it as be pretty happy. That's a good rate of return. But man, letting it go and turning it into millions is a much better option. So yeah, I'm a big proponent of trying to keep some of these things just keep going. With Adobe or whatever it is, they're really well run and they keep on moving. One strategy that we employ is what I call the fruit tree strategy. So in other words, we'll pick some dollar amount. So when that thing gets to $1 million or something, we'll start to take money off and just to diversify. So it gets to 1,200,000, we'll take $200,000 off, and so next year it turns into 1,100,000, I'll take $100,000 off. So it's like I call it the fruit tree because it just keeps kind of producing, and that way we can diversify. And so it's a sort of splitting the difference instead of selling the whole thing just because it's up a lot. I have had clients that kind of panic. It's like, oh my gosh, this is up so much, and then they sell a big chunk of it, and it keeps on going. So anyway, that strategy, letting the winners run, that's a difficult one to employ, but there are some ways to look at it and some ways to maybe do it that do help, at least mentally. So yeah, it's a good point. It's a good point.
So this is something that we've seen a couple times. Is I was pitched the idea of using a whole life insurance as a gift for my grandson. I put in $50 a month. Is this a good idea? And what are some other options to actually, set up something for my grandson that grows?
Yeah, I haven't seen it as much, but it used to be pretty popular to buy a life insurance policy for a grandchild, for example. Um, and a whole life policy would have some cash value in it. So if you're putting in $50 a month or whatever it is into that, it starts to build up some cash value as far as that goes. And then if that grandchild happens to pass away, then there's some money to the family to, handle burial expenses and those types of things. I'm not a huge advocate of it, to be honest, just because the biggest payoff would be the grandchild passing away, at least financially, which is not what you want. Um, because the grandchild's cash balance inside of that whole life policy is going to get eaten up by the cost of the insurance and eaten up by all the different fees that are there. I'd much rather go out and put $50 a month into VOO, which we were just talking about, the S&P 500 fund, with Vanguard, and let that be a legacy for your grandchild. As far as that goes, that could be something that has some great value. The internal expenses on that are 0.03%, so they're practically free. So it's not getting eaten up. Especially if you're dollar cost averaging in, even if the market does fluctuate, it can take somewhat advantage of that with dollar cost averaging. So I don't see that as much. I do run across, a fair number of clients that still have, usually it's like a $10,000 policy that somebody got for them at some point in time. Um, and it's just, like I say, it's not something that I would do personally, but I think there's other alternatives.
Yeah. So like if you think they're going to go to college, you could set up a 529.
Yep.
If you just want them to get the assets, you could set up like an UTMA kind of account, which is kind of like a managed custodial brokerage account that eventually transfers to their child.
Yep.
And so these are accounts that are kind of meant to set up to transfer assets to children
Yeah.
or be used.
Yep. Exactly. Yeah. So that's nothing. Those all work.
So we've talked about multiple times, how delaying Social Security can really add up with that 8% up increase every year you delay. What are some strategies that clients have used to, set yourself up to actually be able to delay with Social Security?
Okay, let me describe those parameters real quickly. So, if you get to full retirement age, let's say it's 66 or 67, and you decide to wait, every year that you wait, actually every month that you wait, your benefit goes up 0.75%, which adds to 8% a year. And so by age 70, you can have quite a bit of increase on your total, benefit. And then that bigger dollar amount at age 70 or what have you is now growing, off of a bigger base. But you also get the cost of living increase. So for those people that delay next year, for example, you're going to get an 8% increase. Plus, you get the COLA. The COLA was just announced at 5.9%. So if you think about that, next year, those people that aren't taking Social Security are getting a 13.9% growth in their benefit. And so every year they wait, it grows, right? And then they've got a bigger chunk at the end that goes with them for life. And their future COLAs that they would get after age 70 are off of a bigger base. It's a big, big deal. Now, not everybody can afford to do it. 58% of the people take Social Security at age 62. Only 8% of people take Social Security at 70. And so there's lots of reasons for that. But one of the big reasons that people take it at 62, because they don't have any money. The average retiree doesn't have any money. And so it's basically a welfare program in that group in the sense that, that's why you should take it, honestly, if you don't have any other resources. And so that's what the question is asking. If I don't take it, what do I do to live for, if I'm 65 now or 66 and I don't take it until 70, how do I get by? Well, that's where really we plug that into the financial plan and we use this sequence of withdrawals and we take a look and say, okay, if you don't take it and we expect some type of an increase in Social Security and I have to take it out of an IRA or a taxable account or something along those lines, how does that compare? So that's why the best way to answer that question is inside of a financial plan where we can see, okay, how does that impact the other assets that they have as far as that goes? But generally speaking, that's exactly what we do. We just set up a distribution using the sequence of withdrawals, the optimal sequence of withdrawals, to accommodate the retirement income needs and let that thing grow for as long as possible. But it's a tough one. A lot of people, are worried about how long they're going to live, but there's a lot of ways to test all of that. But it's a good question. It's an ongoing thing. We get asked that type of question a lot, actually.
Yeah, and it's one thing I want to point out is that 8% guaranteed growth is something that is very hard to achieve. And so having that on some portion of your income in the future is pretty powerful.
Yeah, I mean, if I took it at say, 62 and I could get 25,000, or I take it at 70 and I could get 35,000 for the rest of my life. That's a pretty big difference. I mean, knowing that the government is behind that, and really honestly, you should understand that it's not going to fail either. So that's important. But that's a big deal. I mean, working with clients who have, that kind of chunk of income coming in every single month, it just takes a lot of pressure off of the stock and bond market portions of their portfolio. And I think it's worth the wait. And if you do die young, honestly, the most risk you have in a financial planning scenario is living a long time because it makes your money have to work for a really long period of time to support you, and inflation and all those things are going up. If you do die young, you might have been better off taking it early, but that won't be your main consideration. Believe me, you're not going to be bemoaning taking Social Security. So really, I think, it depends. You have to have the assets to live off of, and that's what the question's about. And so figuring that out and figuring out where to take it and how to take it, that's important. But assuming you do have those assets, then you can kind of take a look at all those different options. It's a good question.
So this is another tax question is what's an effective tax rate and how does that compare to a tax bracket?
Yeah, so okay. Effective tax rate is your overall tax rate. So the brackets are graduated. A certain amount of income pays zeros. Another certain amount of income pays 10%. Another pays 12%, 22, 24, 34. I can't remember the next one. So nonetheless, those are tax brackets. And so so what bracket you end up in would just be that kind of top bracket. But your blended rate of tax is all of the brackets together, and that would be your effective rate. So in other words, I could be in the 32% tax bracket, but my effective rate might only be 21% because I'm only a certain portion of the money I pay zero. Another portion of the money I pay 10%. Another portion of the money I pay 12. And so really the effective tax rate is probably the most important because it's literally what's going back out of your pocket from your gross income. Having said that, the tax bracket itself can be very important to understand because if you take additional money, let's say, hey, I'm going to take 100,000 out of my IRA, that's going to be on top of all of your other incomes. And so you're actually going to pay whatever bracket that puts you in. And it'll obviously raise your effective tax bracket. But when we're looking at the calculations, the effective tax bracket is important for overall planning, but the tax rate on the top is important for those decisions for adding income. For maybe I'm going to convert from to a Roth and take some money out, so that you're going to pay at the highest rate for that new money coming out because all of your other income's already in there as far as that goes. So it's a little bit confusing, but in essence, there's two different ways of looking at tax. One is the kind of the top tax bracket that your money's in, and then the overall blended rate is the effective tax rate bracket. Both are useful pieces of information, in the process of trying to, do tax planning.
Yeah, and one important thing is also when you retire, you also stop paying your FICA taxes, which are your Social Security and Medicare taxes.
Yeah.
And so that's a big drop in your taxes
Yep.
too.
It is. It's actually huge as far as that goes, and tax planning is an important component of a successful retirement. Trying to figure out how to pay your fair amount of share of tax. Nothing wrong with that, but not overpaying taxes just because we don't understand how it works. And unfortunately, a lot of times when you're looking at a tax situation, almost everybody has a tax preparer. Okay. So somebody who you send all the documents to and they make the forms and you sign them and send them into the government. That's a tax preparer. And sometimes they'll give you information about what's happening that year, and, that you're filing that tax return for. And then, maybe what might be looked at for this year coming up. Tax planning looks at the rest of your life and tries to project out different situations and what's going to happen with required minimum distributions and how am I going to handle this tax situation. And so it's a huge differential. Tax planning is a totally different concept, and it can be very, very powerful, and it can really add up to a lot of money that ends up in your pocket if it's done correctly to make sure that throughout the entirety of your retirement you've got some situations set up. And then if you're not retired, no matter whether you're 20 or 60 or what have you, there's a whole bunch of things that we want to look at for structuring your assets so that when you do get to retirement, you have the most efficient tax situation you can. And of course, they change the laws, and we got to change those, parameters and try to figure that out. But it's a really big deal. This is a big portion, of what here's my thing about taxes. I think it's interesting. If I decide to cut back on my expenses, say $10,000, and because of that, I can't go to Hawaii this year or do something I really want to do, but I really want to save money. Or I could save $10,000 in tax, still go to Hawaii. I'm still saving $10,000. I'd love to work on the tax portion because that isn't as painful as some of the other cuts that might need to be made to make things work, right? And so really focusing on that, you'd be surprised what you can find in a long-term tax plan. I think that's really critical. It's a piece of what we, employ when we're looking at things, and again, we have lots of exposure. We've been walking through these paths with clients that are retired, and we watched how the tax situation works out. And we've been able to kind of now go back to those people that, aren't retired or newly retired and get them structured. I know for me personally, it's helped me tremendously to see, year after year, all of these people moving through their retirement and watching what tax structure works and how to set things up. And so it's a surprisingly big piece of the puzzle.
Yeah, and that's why we always try to emphasize sequence of withdrawals, because if you do that right, you're taking your money at the most tax efficient way, which really stretches the money. And so like just being optimal with your taxes can save you, just add so much more to your retirement.
Yeah, it's exactly right. It's you know, we try to make retirement successful by getting a higher rate of return, right? I mean, that's a big one. We're always working on that, working on the asset management. But there's, the market is the market. I mean, all kinds of crazy things can happen. We could actually have a pandemic, which, we never thought about, at least seriously, before last year, and the market dropped 35%. And there's all these crazy things that can happen inside of your portfolios that can impact your basically your revenue sources. Where at the same time, taxes are a much more known entity, and if we can save 10,000 in taxes, over some period of time, until they change the tax law, that's going to work. And so, so there's more certainty in trying to achieve really, a higher net worth through tax planning than there is through asset management. Yet almost nobody focuses on the tax planning part. They focus on tax preparation. That's a huge issue. We get lots of calls about people looking for 1099s or, whatever, as far as that goes. But I think there's a big miss there that in terms of just focusing on what's going to happen, especially with required minimum distributions, which is the requirement to pull money out of your IRAs and retirement plans after the age of 72, and how to handle that and how to make that work as efficiently as possible. And you'd be surprised. I mean, it could add up to a huge amount of money, over the course of your entire retirement. And a successful retirement is all about kind of maximizing the financial pieces, maximizing your Social Security, maximizing your taxes, and maximizing your portfolio return for the risk that you're willing to take. Those are the key issues. And so that's what a successful retirement's about. And then that allows you, once you get those things going and get that in place, and and you have that really rolling, that allows you to you can go to Hawaii, you can do these different things, what's happening, and you've got a really strong situation. And I think it helps people sleep better at night, to kind of knowing that they're in the right spot on all those areas. I think it's critical. So all right, so we're reaching the end here, almost 1 o'clock, and really want to thank everybody for coming today. The S&P 500, as I looking at it right at the moment, is desperately trying to get into positive territory. So we'll see what happens as far as that goes, but very, very close. Again, really good week for the market. It's super fun to watch a week like that just happened this week. So I want to thank everybody so much for coming. Really enjoy doing the show. There's some great questions today. And again, if you want to subscribe to the channel, hit the subscribe button, send us your email, or book an appointment if you'd like. Also, we'd love to be able to talk to you about, your specific situation. Anyway, we look forward to seeing you next